right, 2023 is shaping up to be an interesting year as far as the global economy is concerned, with a lot of moving parts. You've got high levels of inflation, central bank decisions, tightening, crucial elections, the lingering pandemic, geopolitical concerns, war, all part of a cocktail mix of headwinds and opportunities facing global investors across different sectors. Nigeria features, of course, prominently in that mix. Here to talk to us about their outlook for 2023 is Wale Okunriboye, Chief Investment Officer for Access Pensions. Wale, good morning to you. Great to have you on the show finally.
Thanks for having me here, Roger.
You're very, very welcome. So look, your reports, you talked about how your outlook about a possible end to central bank tightening. But if we look at what happened with the MPC yesterday here in Nigeria, and then the language from Christine Lagarde, the ECB president, it suggests that tightening might still continue. Does that change your outlook? What do you make of that development there globally?
Okay, so our view really is in relative terms. So relative to last year, last year you had in the US 425 basis points increase in the key policy rates. And that's because inflation went to levels that people hadn't seen in decades. And so central banks had to take monetary policies to levels that were unprecedented, really. So relative to those levels, we think that as inflation starts to moderate this year, and already if you look at the latest CPI numbers from the US, in December numbers, you're starting to see inflation coming down. We think that means that what you're likely going to see is a slowdown in central banks are going to apply brakes on tightening. So it doesn't mean you're not going to get rate hikes. You will get, but relative to last year's unprecedented levels, we think it will be more modest. In Nigeria, our views for Nigeria, we think last year, central bank raised interest rates by over 500 basis points. We're at record levels, levels that we haven't seen using the official NPR. And yesterday as well, they also took it up. And the reason, if you really look at it, is because even though inflation showed a bit of slowdown, the outlook still suggests things are still going to get worse. And that's because there's still potential adjustments, whether it's the fuel price. In December, the average person paid around 200 Naira per liter, whereas the official pump price is 175. At some point in the year, we think that there will be an adjustment, upward adjustment in fuel prices, some levels, higher levels. And we think that will drive another layer of price increase across the economy. The exchange rate as well. You've seen, last 1 year, the official rate has steadily moved up. You're also starting to see within the secondary market, it's also moving higher as well. So we think the official rate would also move higher as well at some point. And so just those two means that inflation will remain stubbornly high this year. And I think for the central bank, they're probably looking at it that, look, if our policy rate is at 16.5, inflation is likely going to stay 18, 19, 20, 21. Then of course, we have to take it higher because long-term inflation in Nigeria is around 12%. Central bank has a target of 6 to 9%. So it's way outside their target zone. So they want to bring it towards there. So raising rates, I think, would, but related to last year, not so much, I would say.
Okay, so you're in the pension space. What does a higher benchmark interest rates do for the money markets and fixed income? Does it, for your pension, your assets under management, at least in the fixed income money market space, is that repriced upwards?
So I'd say this is a positive from a yield perspective because in the last 3 years, rates have been low. We've had to deal with, there was a point where treasury bill yields were around 0.5.
Right.
And so generally as interest rates are higher, it's generally better. And our sense is that what you find is that investment returns as a whole will drive higher. The lion's share of pension assets are invested in fixed income securities. So a higher interest rate environment sort of does much better to those returns relative to trend levels. The key thing is, are we able to do better than inflation? I think that's why people will look at the central bank decision as, 17.5. So what that suggests is that, if market rates move towards those levels, then relative to long-term inflation around 12%, then you would expect pension fund returns to be at least above that.
Okay, so you guys are smiling.
Well, it's a better year, I would say.
Your oil price outlook, I think your report says between $70 to $80 per barrel. Does that include China's reopening?
Yes, to a large extent. And I think last year, oil prices averaged $100 a barrel. The key impetus for that was Russia's invasion of Ukraine. But what we've seen is that since then, higher oil prices typically induce a pullback in consumption across developed markets because, if you're paying more for fuel at the pump, you definitely have to cut back on other things. And so we think this year, if you look at the IEA reports and most market reports, global consumption is expected to drop way below the 100 million barrels per day we crossed last year. And so if that happens, and importantly, OPEC members have generally been able to raise their own output production levels. After a while, they're finally able to bring it back up. then it suggests at some point the market would move away from this. Last year was characterized by there's not enough crude barrels to satisfy everybody. This year is more likely going to be there's too much crude barrels floating around, and that means price would have to be lower relative to last year.
I have to bring up a domestic issue here. I don't know if you heard about the Abuja-Kaduna rail line being delayed because of either it was bad diesel or shortage of diesel or so on. Diesel is, of course, deregulated here. I'm not sure if you can make sense of that. What's your assessment of Nigeria's downstream sector as far as oil and gas is concerned?
Yes, so I think the downstream oil sector is not vibrant, primarily because you have the largest share of product is really petrol, and petrol is regulated. And I think what's currently happening now, whereby we have queues all over, is simply because it's unlikely that we've gotten to a point whereby the price we've been selling fuel at, demand is way, way, way above where potential supply can be at that price. So there needs to be some adjustment. I think the government has been shouldering that burden on the subsidy side, and it looks like, last year it's estimated we spent around 6 trillion naira. How much longer can we continue to carry that 6 trillion naira burden? I suspect, possibly, maybe once we get past elections to a new government, there will have to be some adjustments in petrol prices. For diesel, we think that is linked to FX issues. So diesel is deregulated, as you said. So any issues you have there typically are supply chain issues linked to most likely accessing FX. If the big players there are unable to access FX, then of course you have issues with diesel supplies. But I think generally what you've seen is that the diesel price has reacted more significantly. So it's trading at a very large discount to petrol price. And that's because it's reflecting the fact that the international price is high, and also the FX rate at which they are able to source imports is also quite high as well. So my sense is that more likely it's probably a supply chain issue, and I think once it's resolved, it would have better support.
Great stuff. You're talking about adjustments. I have to ask you about, also in your report, adjustments on foreign exchange. And I think in an earlier answer, you touched on that as far as other factors. But I think your outlook for the official rates is what, 500? North of that, or 500. So explain the metrics behind that movement of the exchange rates officially. And then what does that mean for the parallel? If you're moving to 500, does that mean we have a parallel rates later of 850 or 9 or something, or 780 or what?
Well, so for the exchange rate, I think it would be difficult to always try and put a number on the parallel.
Yeah.
So what we can look at and what we can see is the official. And for the official exchange rate, what you're seeing is that within the official windows, some of the central bank intervention sales are now taking place at closer to 500. So the official is still at 461, but the SMI's intervention sales they carry out, you see it's 490, 500. So it tells you that already within their own segment, within the official windows, you're getting some relaxation of the peg that you're seeing there. And we think over the year it would have to move higher. And the reason is because for foreigners to come into this market, the big issues we've had over the last 2 years have been low oil production, which has been not much in terms of oil inflows, and as well as also the subsidy as well. So central bank hasn't got much dollar inflows there. And then also, because interest rates were low, foreign investors didn't really come into the Nigerian market. And of course, because of the way we manage our FX system. So if oil production starts to pick up and interest rates are now much higher than we were, then the only thing that's left is for the current is what price do they feel confident in coming to Nigeria at. We don't think that price is a number that's sub 500 naira. We think it's a number that's higher than that. Yeah, where exactly, I don't know, but I don't think it's a number that is sub 500. That's my sense.
Interesting here ahead. We've already talked fixed income and money markets as far as what the benchmark interest rate rise means for repricing for your pension assets. What about the equities market? How do you see that playing out? The NGX and this, stocks and so on.
So Nigerian stocks have surprisingly for the last 3 years been in the green. Despite all the
all the challenges.
All the challenges. It's been positive. And when we look through, what you realize is that it's really just a handful of names that are dragging the broader market higher. I think there's a coin people use, which is stocks worth over 1 trillion naira suits. So these suits, they're about 5, 6 in number, and they tend to drag the wider market higher. So just because they're moving higher, and these are names that telecom names, Downstream, then I think the Boa Cement and Boa Foods. So typically what you find is that anytime you see big activity in these names, and these names are names that fundamentally have been doing quite well, and pretty much is where a lot of investors are pretty much confident about, any positive increase you see, they tend to drag the wider market higher. So if you disaggregate market returns last year, it really boils down to the positive moves in these 5 names. 2 of those names were because are dual listed stocks. So you had this, because they're listed in Nigeria and in London, foreigners who want to repatriate dollars out of Nigeria can use those two names. And so typically what you find is that two of those names, I think Airtel and Seplat, have been in demand. And Airtel in particular is the most capitalized stock in Nigeria, primarily because of that, because a lot of people are using it as a way of repatriating dollars out of Nigeria. And so we think at that sense, even though, yes, interest rates will remain high, just because these names are generally the big drivers of market returns, more likely you see downside to the equity market is limited. Although after 3 years of gains, you wonder if that run can continue. Yeah.
The elections and the subsequent power transition, is that in any way going to be a drag on the economy? For example, does there have to be no delays in getting the cabinets together? How do you feel the elections are going to impact things for the economy this year?
So you have the usual, drag, because the Nigerian government, anyhow you look at it, is still a big influence in terms of economic activities. And so naturally everyone always wants to figure out what's the president, what's the identity of the president, what's the economic team going to look like, what's going to be their immediate priorities. And so the first half of the year, it's pretty much people understand, okay, the current government is on the way out, so you may not find that much influence. But second half of the year, depending on how quickly we're able to, the new government is able to come in. The last time around as well, we had a bit of a long delay before the ministerial list was released. And so I think what that usually means is that if you go back and look at history, election years, transition elections, those elections that you have this kind of crossovers, not much really happens in the economy until maybe Q3, Q4, when everybody is in. Because really, what are you planning against? You could come in and the new government comes with an entirely different set of policies from the existing policies that subscribe, or completely different posture. So the sense we get is that what you see is we'll just muddle through this year. We expect Nigeria's oil production to come back. You started to see a recovery last year. Last year, we had all the issues with theft and everything, production dropping below 1 million barrels per day. But starting in December, I think you've seen production come back to 1.4. The government is able to get things to around 1.4, 1.5. It means that you will see that recovery reflected in stronger oil numbers. On non-oil side, last year, despite all the issues, Nigerian non-oil GDP still expanded around 4%.
Yeah.
So, the real drag really came from oil. So I think what it just shows is that to a large extent, the Nigerian non-oil economy is resilient. And the extent to which it gets interference with policies that don't work in its place, you're saying that those policies are not too choking, then it always moves on. So
optimistic notes to end our interview on. Wale Okunriboye, Chief Investment Officer with Access Pensions. Thank you so much for joining us. Appreciate your time.